Hi, this is Steve Hutchinson with Hutchinson Family Offices, and this is the second video in a series of 3 that we have put together for the month of May. And in this video, I want to talk a little bit more specifically and give you some information about what we're seeing as far as the Federal Reserve is concerned. Now, as we all know, the Federal Reserve is mostly, their primary role is to fight inflation and make sure unemployment numbers stay low. That's their 2 premises, inflation and employment. That's what they focus on. And as we know right now, we are battling some significant inflation. This video is actually being recorded at a couple days before the previous month's inflation numbers come out. The consensus is that we would see inflation at about 8.1%. We would not be surprised if it came in at 9 or 10. And the reason we believe that is we're seeing a lot of inflation at the consumer level, and a lot of this inflation is being created by shortages. So the folks that are communicating from our government are right in some respects in saying that shortages and supply side or supply issues are creating some issues with inflation, and they are. And then the other side of the coin is in some cases they're really not completely accurate. But bottom line is that it costs you more to fill up your gas in your car, fill up your tank. And if you're a young mother and you're looking for baby formula, you're having to look a lot harder to find it. So we do have some supply issues. And we're starting to see some of these supply issues creep in. Will inflation continue at the current level? I think that's a really good question. My expectation, based on my experience in the business and being an advisor for almost 40 years, is that probably we will see a continued inflation for somewhere in the neighborhood of about the next 6 to 9 months. Now, when I say continued inflation, will we go back to the days when Ronald Reagan first took office in the 80s or Jimmy Carter back then? I don't know. I really am not entirely versed enough to draw the conclusion on that. But what I can say is it's going to take a while to correct these supply imbalances. Now, a significant amount of our monetary policy is dictated by inflation. So the Federal Reserve is in a very difficult situation. They see a fairly strong employment market. Yes, granted, we still have a number of unfilled jobs in this country. We could employ a lot more people if they would go out and work. But we have a lot of folks that are leaving the employment market. So that's going to cause some type of transitional shift in employment versus employees, if you will. So the bottom line is what will we see on inflation? The Federal Reserve is fighting the battle as best as they can. They raised interest rates just recently at the meeting. They pretty much said they believe they have things under control, and we certainly hope that they do. But the bottom line is the Fed's got a big balance sheet to clean off. And they're sitting on about $9 trillion worth of assets on their balance sheet, and they've got to eliminate those. And so that's going to force interest rates in the short run up quite a bit. And so that increase in interest rates is going to have an effect on demand. It's going to have an effect on capital expansion. And in part, it may actually drift into somewhat of an economic recession. Now, the last quarter GDP, the first number out, came in about down 1.5%. It's not exactly clear that that's going to be a trend. Was that a carryover? I'm not really sure. But we don't see declining GDP on an ongoing basis or some type of recession. I think the Federal Reserve, I believe the Federal Reserve, is doing as best as they can with what they got. They were a little slow at the draw. They should have started this process sooner. And I don't believe, I'd like to think that they weren't politically motivated, but I'd have to say that the timing of their slowness to the draw was really quite interesting. But quite frankly, they've got to start unloading the balance sheet at the rate of, I think they said $95 billion a month. And then, of course, we're going to see some gradual increases in interest rates for the balance of this year. That's going to have an impact on the housing market. As mortgage rates go up, fewer people can qualify for mortgages at a certain dollar amount. We're already starting to see some slowdown in certain real estate markets. We're not seeing a big slowdown, but we are starting to see some, or we're starting to see some pushback. So generally speaking, employment remains strong. The Federal Reserve is doing as best as they can with the employment market. We still have many jobs that need to be filled. And the Federal Reserve's policy on clearing the bank balance sheet remains to be seen, but we're optimistic that they're going to be able to get it done. So as an investor, where would I be putting my money now? I would continue to recommend that the majority of investments that you own today should be in what we call passive investments and also equity-based investments. So sit down with your financial advisor, talk about your asset allocation, because this is critical. What we saw for the last 10 years may not be what we see for the next 10 years. And your future may depend on whether we have an inflationary environment, which may make you want to invest in real estate more rather than, say, equities, for instance, or equities that are more prone to not be affected by real estate. So rest assured, we're focusing on where the risks are in the financial markets, and I think you should too. That'll do it for this month's video. Thank you.